Welcome to US Market Pulse, your trusted source for clear and in-depth analysis on gold, silver, and the US financial system. Today is January 2nd, 2026, and we are entering this new year with a market event that deserves your full attention if you hold gold, silver, or any asset tied to financial stability. Over the past trading sessions, gold and silver experienced one of their sharpest coordinated sell-offs in recent years. Gold dropped roughly 5% in a single day, while silver collapsed by more than 11%. This was not a normal correction. The move was fast, aggressive, and largely indiscriminate. Many headlines blamed profit-taking or a stronger dollar, but those explanations fail when you look at what was happening beneath the surface. At the exact same time gold and silver were being sold aggressively, the Federal Reserve injected more than $52 billion into the repo market through emergency liquidity operations. That number matters. Under normal conditions, repo usage typically stays near $5 billion or less. When tens of billions are injected suddenly, it sends a clear signal that someone in the financial system needed cash urgently and could not get it from private markets. This is where many investors misunderstand moves like this. Institutions do not sell assets during liquidity stress because those assets are weak. They sell because they need cash immediately. And the first assets to be sold are not the worst ones. They are the most liquid ones. Gold and silver futures, ETFs, and derivatives are among the most liquid instruments in the world. They can be sold instantly and in large size, which makes them prime targets during forced liquidation events. There is no evidence that physical demand for gold or silver collapsed during this sell-off. Reports from dealers showed that physical premiums remained elevated and in some cases even increased while paper prices were falling. Central banks did not reverse their accumulation programs. Industrial demand for silver did not disappear overnight. This tells us something important. The selling pressure was concentrated in the paper market, not the physical one. What likely occurred was a classic liquidity cascade. Large institutions operate with leveraged positions in gold and silver derivatives. These positions are margined. When volatility spikes or prices move sharply, margin requirements increase. That forces traders to post additional collateral. If cash is not readily available, they are forced to liquidate positions to raise liquidity. During thin holiday trading with fewer buyers present, those sales can quickly overwhelm the market, triggering stop losses, algorithmic selling, and further margin calls. This is how controlled markets suddenly turn chaotic. It does not require manipulation or coordination. It only requires leverage combined with a temporary shortage of liquidity. The Federal Reserve's response shows how close this situation came to becoming something larger. The standing repo facility is meant to be a backstop, not a regularly used tool. When it begins to see repeated and large usage, it signals stress in the plumbing of the financial system. By late December, bank reserves had fallen to around $2.8 trillion, the lowest level in several years. Quantitative tightening officially ended on December 1st, but the effects of reserve drainage were already in place. At the same time, Treasury issuance remained heavy and foreign demand for US debt continued to weaken. In that environment, it does not take much to trigger a funding squeeze. When short-term funding markets show signs of strain, the Federal Reserve steps in, not to stimulate markets but to prevent the system from seizing up. There is debate about whether this represents a quiet return to quantitative easing. Technically, repo operations are not the same as asset purchases. But markets do not trade definitions. They trade outcomes. Gold does not care what a program is called. It responds to real yields, currency credibility, and systemic stress. Some analysts view this event as confirmation that the financial system is becoming increasingly fragile. Others see it as a temporary liquidity disruption within a system that will always be supported when stress appears. Both views are reacting to the same underlying reality. The system remains extremely sensitive to tightening. History provides context. In 1998, emergency interventions stabilized markets but encouraged future leverage. In 2008, massive liquidity injections saved the system but inflated asset prices for years. In 2019, repo markets seized unexpectedly, leading to interventions that quietly evolved into easing. In 2020, gold initially fell during the liquidity scramble, then rallied sharply once stability returned. Gold tends to sell off at the start of liquidity crises because it is used as a source of cash, and it tends to perform well after those crises once liquidity conditions improve. Another important signal in this episode was the disconnect between paper prices and physical availability. Silver continues to face structural supply deficits. Mine output has not meaningfully increased, while industrial demand from solar energy, electric vehicles, and electronics continues to rise. Paper selling can suppress prices temporarily, but it cannot create physical metal that does not exist. Looking ahead into 2026, the most likely outcome is volatility. Not an immediate collapse and not a straight-line rally. The Federal Reserve has shown repeatedly that when forced to choose between discipline and stability, it chooses stability. That choice has long-term consequences for currencies and real yields. For investors who are over-leveraged, this environment is unforgiving. Sharp moves will continue to flush out weak positions. But for those holding physical gold and silver as long-term monetary insurance, events like this have historically marked opportunities rather than endings. Price action alone never tells the full story. You have to ask why assets are being sold, who is selling them, and under what constraints. In this case, the evidence points to liquidity stress and forced liquidation, not a rejection of gold and silver's role in the financial system. If anything, this sell-off reinforced why hard assets continue to matter in a system that depends on repeated intervention to remain stable. If you found this analysis useful, subscribe to US Market Pulse and share your view in the comments. Was this sell-off a warning sign of deeper trouble or a calculated shakeout before the next move higher? Stay sharp, stay informed, and I'll see you in the next update.